What's your sense, Valentin, of the implications for a dollar of a Fed chief and a Treasury Secretary arguably working closer than ever before to try to reignite some sort of growth?
I think that at least initially that should be dollar negative. Fact being that where the Fed and the Treasury could work together, they will definitely try to restore the U.S. economy back to health, back to more normal conditions, and fully conscious of the limitation that the Treasury now has to work in isolation, given the gridlock Congress that we will likely have next year. So that may mean that the Fed will be more activist and will be working more closely with the Treasury, which could result in potentially even lower real rates, real yields in the U.S. The Fed is also trying to deliver on its average inflation target. So the dollar or weaker dollar could be a big part of that. There is still hope that weaker dollar could help really at least partially kind of address the current account deficit issue that the U.S. facing. And so long as the U.S. is not facing any difficulty really attracting foreign inflows on the back of concerns about deteriorating fundamentals or indeed, for that matter, very weak dollar, so long as that is the case, some further controlled depreciation of the currency may be the preferred option for both the Treasury and indeed the Fed in coming months and quarters.
Which would be an interesting divergence from the past, where the U.S. has traditionally had a strong dollar type of policy. You mentioned negative real yields. I'm looking right now. Tom has been mentioning this all week, rightly so. Negative real yields, negative 1.04% on the 10-year if you basically take away inflation from the actual yield. How low could we go in the United States with Fed backstopping the debt markets?
Well, we believe that we could go a bit lower still. Our forecast for nominal Treasury yields is that they're going to be quite stable, around 1% or just below 1% for a foreseeable future and into well into 2021. And with the inflation now expected to recover gradually, that could actually give you even lower 10-year Treasury yield compared to current levels. It is also important that this much from a dollar standpoint, obviously what matters is how this compares with real yields outside of the U.S. That's not going to bode well for the dollar because real yields elsewhere could actually fare quite favorably with the real yields in the U.S. and could translate into further dollar weakness. And that may well be by design because, as I was saying, the Fed is indeed trying to refuel really the U.S. inflation and ultimately deliver on its average inflation target.
Valentin, where's the trade right now? Where's a trade? I mean, Bloomberg writing up the carry trade today. Where's the intelligent speculation right now?
Well, intelligently, any speculation, but I do believe that short dollar against the so-called pro-cyclical currencies still makes a lot of sense. Fact being that I was mentioning that earlier, the trade flows that could result into weaker dollar are still to come. Our own data is not showing necessarily that corporates around the world have started selling the dollar in earnest and have been hoarding the dollar for a long period of time, something that's quite unusual. So you would think that euro dollar at 125 or indeed dollar renminbi closer to 620 could be still on the cards, if only because those flows are still to play out really as a major market driver. Beyond that, I do believe that notwithstanding the risks going into the year-end, government shutdown in the U.S., or indeed no trade deal Brexit, notwithstanding that, we are heading to a much better year in 2021 than we had in 2020.
Well,
so this much should ultimately support carry trade. It is, you mentioned that, but I do believe that the likes of yen and Swiss franc should ultimately come off the boil, and these could make a very interesting short on their own right.